Thanks, Christian, and good morning, everybody. It's Daryl Jones, the Director of Research at Hedgeye, and I'm standing in for Keith this morning. Wanted to start off with the top three things in Keith's notebook. Top of the list is Asia. Broad-based selling in Asian equities overnight. Hong Kong down about 1.7%, China down about 1.5%, and the Kospi down about 80 basis points. Key driver here was the world's growth expectations got rightly concerned about importing inflation via a renewed U.S. burning buck, and this is sort of driven by this new concept of sequester relief, which is effectively more spending by the U.S. government. U.S. dollar's been down for 5 straight weeks, and basically this is being driven by the fact that the taper in the short term it seems increasingly unlikely. Flipping over to the second thing, inflation. In short, it's back. After bottoming in mid-November, one proxy for global inflation, the CRB Commodities Index, has put on about a 3% move off the year-to-date lows. CRB was at one point down 8% on the year at its lows, which obviously fuels consumption growth. Now as we sort of look prospectively, almost every economic region other than Europe should see an increase in inflation year over year, or not year over year, but from Q4 to Q1, and this is obviously negative for economic growth. Last key thing in Keith's notebook is gold. We had a trading position on, and while being long, no taper, inflation expectations is cool. It's only cool to a price. Gold crashed this year pretty dramatically, and it's going to take time to bottom. As we like to say, bottoming is a process, not a point. So we sold out of our trading position in gold at the top end of our risk range, which was our immediate-term risk range, which is 12.16 to 12.61. And once to the extent we see a higher low, we'll definitely look hard at buying it back.